All right, thank you. Thank you very much. I want to thank Hubert as well. Just a quick side note, I met Hubert in Las Vegas a couple months ago, had some dinner, very nice gentleman, and it was interesting. A lot of options guys were there. Some guys gamble a little bit, but a few guys don't, and I don't even find Las Vegas to be fun or interesting because you don't control probability like you can in the marketplace. You have so much better control and so much better odds of success if you know how to treat the markets properly. So that's what we're going to talk about today, how to trade the stock market like never before. Let me just double check my audience view here and make sure everybody's seeing my screen. Let me put my questions in the corner here for myself. I'm going to unlock this and put it in the corner. Thank you. Hello, everybody. And I will answer questions at the end. If there's something glaring that comes up, I'll spend a little time and explain it, but let's try and get through this. Today we're going to talk about how simple the markets are. The markets are not hard. You know, the markets can do three things. They can go up, down, or nowhere. That's it. That's all they can do. So let's talk about, you know, having a trading plan. Trading is very simple. You just have to have a methodology. For myself, I look big first. I look to see what the markets are doing. Then I'm looking at individual sectors. Then I'll look at individual stocks within that sector. Then I'll pick the appropriate strategy. I'll weigh the risk and the probabilities. And it's all about money management. It's a process. You're making sausage. That's all we're doing here. So the process here for each and every trade is the same on every trade that you ever enter in every investment you ever make. You identify your trading candidates, you execute with money management, you manage your position so you can maximize it, and then you repeat it. It's it. There's no magic. Trading is very simple. We're going to talk about how to do this in a different way, hopefully, for some of us. We're going to do this to invest intelligently, talk about using probability and putting odds in your favor. So it's not a gamble. I don't believe in gambling. You know, gambling, things are out of your control. Let's use the markets for what they are, for the opportunities, but let's control our risk and understand the probability of each and every trade. So we want to invest with less risk. We want to tie up less capital. And I want to have less time management. I myself, personally, my lifestyle has changed. As they read in the bio, I used to be a very active trader. You know, that's fun. It's probably not as much fun as I thought it was at the time. Now that you step back, the opportunities are there. And now with technology, you don't need to be in a pit and have, you know, be worried about every minute by minute actions in the markets. You don't need to be chained to your computer. I know some people actively trade. That's great if they really enjoy it, but it requires a lot of discipline, an extreme amount of discipline. And at my age and at my standing of my education, my career, I like to trade longer term. So I don't want to have to manage positions. I can look at things more on a weekly basis, look at the bigger overall trends, still take advantage of what the markets have to offer. And I'm going to show you how we do that. But I don't have to worry about the minute by minute, day by day, and I can think big picture. And the whole key is to do this to get greater returns. So let's talk about how to do that, how to trade the stock market like never before. First off, let's talk about the stock market. I took this slide a couple days ago. Overall, obviously, the market's still very, very strong. We made new highs yesterday, continues to go, go, go. And essentially, we've been trading sideways for many months. We've been trading between 2120 and 2040 for the last month and a half. And then it blasted up above 2120 in the S&P, so that looks for more upside. Every single sell-off in the last 5 years has bounced back and made new highs until it doesn't. So we have to respect that overall. Now, we don't want to feel like you've missed out on anything. If you're looking at new bullish positions here, you just have to be more selective, obviously, but I can't stress enough. Every sell-off has been an opportunity, and it's going to continue to be so until the fundamentals change, low interest rates, now we have low oil prices, good corporate earnings, a lot of solid action. So someone's saying they're getting no sound. If you could confirm that we're getting sound, I'd appreciate that, please, because I got a couple hellos and highs. So let me just double check on my audio here. Test, 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 1, 2, 1, 2. That looks like it's working out. Okay. Yes, everybody says it's fine. Thank you, Winfred. Appreciate it. Thank you. All right. So I don't want to feel like you've missed any opportunities. There's always going to be opportunity, and that's one thing that I want to espouse today. That it doesn't matter if the market's going up, down, or sideways. There's always opportunity for those people that have the tools and the skills to make money. So we're going to do that. And every time the market's sold off, it's been an opportunity to buy. And I've been using these rallies as opportunities to sell some of these long positions. So sometimes you've got to get in the mentality of buying when it looks the worst and selling when it looks the best. And that could change. And when that changes, we'll look at opportunities on the downside. But until then, I'm not trying to be the smart guy that's trying to pick the top of the market. That guy's got killed over and over and over. All right, they mentioned I'm on television. That's one of the things I do. I'll be on Fox Business at 2 o'clock Central Time and 3 o'clock. I'm on the Fox Business afternoon panel, so that's interesting when they kind of beat me up a little bit. But that's 3 o'clock Central Time today. That would be 4 o'clock Eastern after the markets close. What it comes down to is I tell people do not watch TV. TV does not help you trade. Actually, it hurts your discipline. You've got a trading plan. You've got a plan of attack. But a lot of times the hype and the infotainment of television and the entertainment value make you stray from your trading plan. So that's the first thing I tell people is don't watch television. I do make a point of going on there and having some actual things to say that can help you make money. Very few of the analysts, very few people on air are going to tell you anything that's going to help you make money. They're just talking in general terms. A lot of it is about fear and what they think could happen and what could happen, what could happen. But how do you make money? That's what we're there for. That's what I try and walk away with when I go on air and try and have a little education and give you some specific things that I'm looking at and what I think are opportunities. And then you can investigate them, see if you agree or not agree. So that's what it's all about. Here, this picture with Maria. Number one, she was on CNBC when this picture was taken. This screenshot. Now, hopefully, I don't look like an old grizzled trader, but I am. I've been doing this since 1990, so it's going on 25 years now. The Dow was at 10,000 when this screenshot was taken. I'm not sure if it was 10,000 on the way down or 10,000 on the way up. So it's been a long time. I've seen every market condition. I've traded in every single market, and I'm going to talk to you about what I think is the best way to approach the markets and what I do now where I see opportunity. Let's talk about the markets first off. The Dow may not make a new high, still not quite there, but trading sideways. Again, you go with the range of that sideways action on top of those old highs. That's the upside target. Thank you. The Nasdaq leading the way up 6% on the year. People feel like we've had a sell-off. We're positive on the year. And if we're a third of the way through, that's still nearly 20% in the Nasdaq. The Nasdaq is leading the way. Tech innovation is leading the way. And I think it was a very healthy sign a couple weeks back, and I use this as a barometer, when Amazon turned the corner and rallied. And then you saw some of these other guys that had been momentum stocks start to play ball again. That was a healthy sign for the market. And then you see everybody starting to get positive now, even with those low, I wouldn't even say low, no expectations earnings quarter. When it comes to markets, we look at the S&P. The S&P is the market, S&P 500. That's what professionals focus on. It's not the Dow. The Dow's only 30 stocks. That's weighted by price, whereas the S&P is weighted by market capitalization, so it's a better indicator. And looking at this S&P, every sell-off has been an opportunity, and this technical pattern targets 2,200, which is minimum 2,200, which is still another 4% above. So there's still more upside. Don't try and be that guy that picks the top. Go with what the markets are giving you. So let's talk about how to trade the markets like never before. Now is the best time in history by far. And we're traders, not investors. A trader is a more intelligent investor. A trader is not a negative connotation. A trader has a plan where they want to get in, where they want to get out, how much they're going to risk, and so forth. A trader has a plan, a more intelligent investor. You don't buy shares of stock, throw it in a drawer, forget about it anymore like we did 20 years ago, because the business cycles have changed so dramatically and things happen quickly. You have to have a trading plan. This is by far the best time in history. Commissions are low. Technology is amazing for the individual trader. You have access to any market, anytime, anywhere in the world, any direction, wherever the opportunity is. Like I said, the bid asks, liquidity is amazing. You can get in when you want, you can get out when you want. So everything is set up. You don't need to be a floor trader anymore to have an advantage, and those guys are gone. Everyone has equal access. So this is by far the best time in history, and as you hopefully can tell, I'm a little bit optimistic. I'm optimistic about opportunity. I tend to be optimistic about the market. I still think it has a lot more upside, but I'm optimistic about opportunity because it doesn't matter to me whether the markets are in bullish, bearish, or neutral mode. There's money to be made. The whole idea here is that we're not gambling. We're trading. It's about risk control. The difference between a novice trader and a professional trader is a professional focuses on risk. What's my worst case scenario? What percentage of my account do I have at risk in that trade? How many dollars? Whereas a novice focuses on what they're trying to make. I want to make 500. I want to make 1,000. I want to make 2,000. But they don't quantify what their risk is. So number one, focus on risk. And very basically, I tell people to divide their account into 20 pieces. So each slice of pie is 5%. So then with that, each slice of pie being 5%, if that trade goes catastrophically wrong, you still have 95% of your account left. Obviously, you're going to have a stop loss in place, but that way, you know, we're not playing Texas Hold'em. It's all about probability. It's about the marathon of trading. And there's an old saying in this business I was taught when I was a very young trader, is trade for tomorrow. Don't trade for today. Make some money today, but trade for tomorrow because another opportunity comes tomorrow. Let's talk about how to do that with options. And I'm not here to dazzle anyone, and I'm certainly not going to dazzle anyone with my options strategies. I want to make it as simple as possible. Stunningly simple. Stunningly simple. So how to use options. And the beauty with options, there's ways to profit when the markets go up, down, or sideways. And you can control your probability. You determine what probability you want. Do you want trades that have a 75% probability? Do you want trades at 80%? Do you want trades that want a 30%? What fits your risk profile? And for me, what's most important is that you have limited risk. You do these limited risk strategies. No matter what happens in the world, you have absolutely limited risk with a lot of these option strategies. The key is to use options to increase your returns. You're using the positive leverage and having limited risk. And for me, staying power is very important. Staying power. I've got the ability to ride through some ups and downs. And you've seen how the markets have done that they've kind of faked like they were going to break down and then they came back. And I'll use options, and I'll talk about the time component, but I'm going to use options that have more time than I could possibly ever need. So I take that component out of the equation so I have staying power. So I can handle those dips. Whereas if you're in this stock outright, you probably don't have the financial wherewithal to ride through that. So let's talk about using the right strategy for the markets. You've got an options toolbox. You can pick out the appropriate strategy based on the market conditions. We're going to talk about two separate market conditions today, high volatility and low volatility. We'll get to that in just a second. But there are different option strategies. You don't want to take an option strategy and jam it in the marketplace if it's not appropriate for how the market's behaving right now. You know, everybody likes to learn a new option strategy and make it work. You know, you've got to find the right tool in your toolbox for the market conditions. So that's what we're going to talk about. You know, you want to pick that right strategy, and the key is to buy more time. If you're an option buyer, to buy more time than you need. Time is your greatest ally. You can't have enough time. Just like in life, you can't have enough time, especially with an option. And that's where people get themselves in trouble, is typically they buy short-term options that are out of the money. So mathematically, you've got the clock working against you, and you've got probability working against you. We call those here in Chicago, in the CBOE, we call those lottery tickets. The out-of-the-money, cheap, long-shot options that have very little time till expiration. That's unfortunately where most people learn about options, is they buy some cheap, crummy, out-of-the-money options because they're cheap, and they have very little time. So they'll buy a front month, you know, let's say a May option. A May option expires in 3 weeks. Okay, so over 3 weeks, if the market does nothing, that option still at the money option, that option's still going to expire worthless. If it's out of the money, it's going to be dead. It's going to melt. It's an ice cube that melts in your hands that lasts 3 weeks. So let's take that out of the equation and buy more time than you need. And right now, options are relatively inexpensive. So I'm buying, even if I think something's going to happen in a month or a month and a half or 2 months, I'm still buying, you know, 6 months of time, because I want to take that out of the equation. For an extra $30, $50, you know, have that extra time is a luxury, because it's the greatest asset you can have is time. So let's get into the simplicity of this. And the simplicity is that the simplest strategy is often the most efficient. And, you know, the most simple direct strategy, straight outright buying calls and puts, you know, you can think of the fact that you don't have multi-legs, which also costs you commissions, and there is also the bid-ask spread on each. So, you know, it's a little bit more efficient as well. So that's something to keep an eye on here. Options are simply the vehicle. You still have to identify whether the market's going up, down, or nowhere, and you want to be in position to take advantage of what's happening using options. So the variables in the options markets that you can determine are direction, price, time, and volatility. Well, which one am I missing here? And volatility. So these are things that you get to evaluate and determine. Now, so if we look at volatility, volatility right now, when I took the slide just a couple days ago, it was at 13. Now it went down to 12 yesterday. So volatility as a measure is at the lowest level it's been in nearly 5 months. So volatility is declining, and you can see a series of lower highs, and overall the trend is down. Every time it bounces back up, when we get this, you know, this bout of fear or this latest crisis du jour, volatility bounces up, but then it gets beaten back down again. So that's important to be aware of. So I've just got a little heads up here that no attendees, no more attendees allowed. So I'm going to click on OK. Hopefully that doesn't hurt anything.
No, Alan, that's fine. If you just check, don't show this again. It's just saying that the room is now maxed out and people can't get in. Just check off don't show me again and you'll be good to go.
Okay. Great. That's what I want to see. I just didn't want to blow out the whole thing. So, okay, so volatility is just one of the options components. That's really the only, we're going to talk about two of the Greeks today. Volatility is one, and in simple terms, is volatility high or is volatility low? If you look at the last 10 years, yes, we're at a low level, but we could go a lot lower. We were below 10 in 2007. So for some people to say, well, volatility's got to go higher because it's at a low level, nothing has to do it. Just because something's low doesn't mean it has to go high. Just because something's high doesn't mean it has to go low. So be aware of that. It's all relative. But volatility is down 35% so far in 2015. So everybody says, oh, it's more volatile, it's more volatile. In reality, it's not. And that's important because options are more inexpensive than they've been in a long time, are less expensive. Is that a better way to say it? Are less expensive than they've been in a long time. So if you look at that low in 2007, we still have 20-some% to go just to get down to those lows. What that tells me is there's more downside of volatility, meaning there's more upside in the market itself. But that's just an opinion. That's neither here nor there. All right, so let's talk about volatility. Let's talk about option strategies for low volatility, because in a broad context, we're in a low volatility environment. The VIX is low, down to 12, and you could see where it was up to 50, it was up to 25. You know, we've really come down. So options, buying puts or calls is much cheaper than it's been in a long time. So as a straightforward strategy, let's talk about stock substitution. And again, it's a very basic strategy. The key is identifying the stock and where you think the stock is going. Is it going up or down? And then using the appropriate options to capture that move. And like I've said many times before, simplicity is the key. Keep it simple, stupid. So the idea here is to use less capital, have less risk, much greater returns than buying or selling the stock itself. And you've got the staying power because we talked about the time. So let me give you a couple examples, but first, right here, everybody should know, each option controls 100 shares of the stock. It's much cheaper than buying the stock itself. The maximum risk is whatever you pay. So if you pay 500 bucks, that's your maximum risk. You pay 700 bucks, that's your maximum risk. And it acts much like the stock in price movement. You get all the benefits of owning the stock, but you've got less risk and less money tied up. And because there's so many buyers and sellers, and now options are priced, a lot of them in pennies, you can get in when you want, you can get out when you want. So there's always buyers and sellers, and we're going to be trading, name stocks that that have a lot of liquidity. So that's very important. So the strategy is very straightforward, very straightforward. Again, the genius is evaluating and picking the right stock. It's not an option trick. Nobody's going to show you an option trick that you can use that no one else has thought about to take advantage of the markets. The smartest of the smart at Goldman Sachs and Morgan Stanley, they're doing complex option strategies and doing complex things, and that's great, but that's not our business. There's nothing that we're going to uncover that they haven't done, and the markets are efficient. If something gets out of line, so if an option's overvalued, people will be selling it. If an option's undervalued, they'll be buying it. So leave it to the smart boys to mess with that. I want to do the easy, straightforward strategy. So buying an in-the-money option, I want to make sure that I have a delta of 75%. Like I said before, people buy lottery tickets. They buy these crazy out-of-the-money options. So if you see, I don't know, let's say Microsoft was at 44 or 45. You think Microsoft's going to go up, and you buy the $50 call. It's not that far out of the money, but mathematically, the May $50 call, even if Microsoft goes up to 50, 50 is your strike price. If it's not above 50, 50 plus whatever you paid in premium, that's still below your break even. So in the next 3 weeks, something major has to happen. It has to move 10%, and if it doesn't, that option expires worthless. That's an that's an out of the money option. An at the money option has a delta of about 50%. I like to buy the deep in the money options that act like the stock. 75% is a nice sweet spot. Now that's the delta, and that oftentimes for our purposes, that is the probability that that option will be in the money at expiration. So there's a 75% chance it's going to be in the money at expiration. So that to me tells me that there's a very high probability. I want to be on that side. Also, I want to make sure that my break-even's $1.50 or less away. So the idea here is that I want to buy an option that's going to profit from just a modest move in the market. Just a modest move in the stock will be profitable. So the break-even is $1.50 away. That's not a whole lot to ask. If I'm looking for a stock to move $15 or $20, it doesn't matter what option you buy. But if a stock just goes sideways, doesn't do a whole lot, and all it has to do is move up $1.50 between now and expiration, I'll be in profitable shape. So if there's just a modest move, I still make money. That's key. Also, I want to buy enough time to be right. I want to buy at least 3 to 6 months of time if I'm looking to buy long options, probably at least 6 months because volatility is relatively low. Take the time component out of the equation. So the idea here is to be in position for success, and to do so, you also want to control your risk. You want to put in a stop loss at half of what you pay. So if you pay $400 for an option, put in your stop loss at half of that, at $200. At $200, so again, I talked about your money management allocation. No one trade should have any adverse effect on your account. A trade's a trade. If you lose on it, you lose on it. So if you put in 5% of your trading account on a trade and you get stopped out at half, you lost 2.5%. You've got 97.5% of your account left. The idea here is to put yourself in position and have a high probability of success. And overall, for the year right now, we're at 73% success of the trades that we've closed out in 2015. So the key here is having discipline and having a plan. That is the plan. Let's look at some specific examples. Here's JetBlue. JetBlue was trading between $8 and $9 for a long time. This was last year, trading between $8 and $9. So look for the stock. If it goes above $9, it's going to have about a dollar move up to 10. That's not a home run trade, but that looks like a very promising probability. Now, how do you play that? You could buy the stock. The stock was trading about $8.40. You buy the stock, and it's going to cost you about $840 for 100 shares. Or your other choice is to buy the in-the-money call. And at that time, this was May, I was looking at the January $7 call. So that gave me June, July, August, September, October, November, December, January. So that was 8 months of time. 8 months of time for JetBlue to move up. All right, the $7 call gives you the right to be long from $7. The option costs $1.85 at that time. So your break even is $7 plus $1.85 is $8.85. So $8.85 minus wherever the stock was $8.40. Then your break even is like 45 cents above. All right, so all I'm asking is in 8 months, can JetBlue move up 45 cents in 8 months? Not asking a whole lot. If it does, then we're in a profitable situation, so it's not asking a whole lot. The maximum risk is $1.85 paid, but you put your stop loss at half of that. So you're really risking $92 for each option for each 100 shares. So you're tying up less money, you've got less risk, your break even's 45 cents away, and your position's going to act like the stock on the upside. So what happens? JetBlue, boom, takes off. Takes flight, gets up to $10. All right? That's a great trade. And over the course of, when did it start? May 8th. May 29th, that's 3 weeks later. 3 weeks later, the stock had gone from $8.40 to $9.65. That's an impressive gain. That's a 15% gain. You got to be happy with that on an annual basis, let alone in 3 weeks. That's a great trade. But what's even a greater trade, an outstanding trade, is that option. That option gained nearly 50%. The stock gained 15%. The option gained nearly 50% because it was an in-the-money call with a high delta. Got to our objective. We took our profits. Now, there was plenty of time left on that option. We had an 8-month option. We got out of it after 3 weeks. I had the luxury of the time if I needed it, but I had it just in case. So again, to review, there's JetBlue taking off, so to speak. The stock goes up 15%. The option gains nearly 50%. And the idea here is less capital, less risk, greater return. The delta on that option was about 80%, so it acted like the stock. So it's a win-win, win-win using options. Let's get another example. Let's look at Apple. Now, Apple comes out with earnings here on Monday. Apple's in a very attractive position right now. I'm looking at it once again. I'm into some Q positions, and we have a Q position in our portfolio at BarChart BULLS-EYE Options as a kind of a proxy because the Qs, 10% of the Qs are made up by Apple. So it's kind of a proxy play there. But I'm very bullish on Apple. It's really stalled out, and I think another push above 130 here. Minimum target's 140. But what I wanted to show here is you can do it on more expensive stocks as well, something like an Apple. And at the time, the stock was trading about $92. And you can see how it trades within these $10 legs, traded between 70 and 80 for the longest time. And then it traded between 80 and 90. And then it came down, and that 90 was support. So this is an example of not having to buy a stock at the low or sell it at the high, is trading a nice high probability chunk out of the middle. So leaning on that 90 support on a weekly basis was really the strategy. Now, how to do it with options. So the stock was trading at 92.65 in June. The in-the-money 80 call for October, so then that would give you July, August, September, October, 4 months, 4 months of time. Being long from 80, being long Apple from 80 doesn't scare me. And if you want to buy the 100 shares, it costs $9,000. That option costs $1,300. So it was a more expensive option because it's a more expensive stock, obviously. So $1,300 added to that 80 strike is $93. All right, so the break even on that was 60 cents higher. So I was asking Apple to move up 60 cents and I would be profitable. 60 cents in 4 months. Not a really high expectation. If it does, moves up 60 cents and more, I start to make money. So I put in a stop loss at half of what we pay. The idea is to have a position that's going to act like the stock. So what happens with Apple? Apple takes off. Now this is an important lesson here because this shows staying power. Our objective was $100. And if you look, it almost got to $100 and then it backed off. All right, the option had the staying power, whereas if you had the stock, you probably got flushed out on that pullback, okay? But that secondary move, it took some time, but it moved back above $100, okay? That was our objective, $100, not looking to hit the home run, probably it left some money on the table, but it's about taking a high probability chunk out of the middle. So the stock moved up, and the stock gained 8%. Now this option from when we got into it was June 17th, 2 months. It was in the position for 2 months, had the staying power of the option. The option gained 51%. So those are two great examples of using deep in money options to participate with the stock substitution strategy. I'll show a couple more, but I want to get into some other strategies as well. Apple looks like it may be showing another opportunity here, but the keys here: buy time, buy something where your break even is $1.50 or less, and buy something that's got a high probability. So that was the logic. Tied up less money, had plenty of time, but I'm going to take my profits and cash it in. If I, a 50% return, hey, you can't ever complain about that. You can never complain about a 50% return. And if it can go without you, so what? You made money. You're looking for new opportunities. There's always a new opportunity. So that took a little bit over 2 months. I've got a number of positions on right now that are January 2016. Not that I'm going to hold them for that long, but I can if I have to. It takes the time issue out of the equation. Quickly review, and then I'll get into the high volatility strategy. The in-the-money option, 75 delta, break even $1.50 or less away, buy enough time to be right, and risk 50%. Those are your rules. Someone asked a question about JetBlue. So about trading shorter-term options. The shorter-term options, you could, but for an extra $30 or $50, you'd be silly not to buy more time, even if you don't need it. There's really no reason for it. Someone asks here, buying deep, a delta of 90%, in the money strangle. I don't want to make it complicated. If I think the stock's going up, I'm buying a call, and I'm buying a deep in the money call with plenty of time, making it easy. I can do my thing. I've got a daughter that plays soccer, softball, and dance. I pick her up from school. We do a ton of things. I'm not chained to my computer like I was years ago. I can look big picture and just check in on the markets, and look at things on more of a weekly basis. So the idea here is, with the stock substitution strategy, you're controlling 100 shares for much less money. Maximum risk is the premium paid, acts like the stock, and you've got good liquid markets. So let's talk about volatility as well. Let's look at high relative volatility. There are individual stocks that have high relative volatility. And that typically for me is something that's got a volatility of 50% or more. So it's got some good price movement. Now volatility is simply opportunity. Someone's confused about volatility increasing as the underlying goes up. Well, volatility as a whole for the whole macro market can increase. And typically it doesn't. There's usually an inverse relationship 80% of the time. If price moves up, volatility moves down, and vice versa. What about the month of expiration? Someone asks. No, I don't like, I'm going to show you that's what this strategy is. This is using that time decay in your favor. The other one is I want to take time out of the equation. I want to, instead of buying the stock and sitting on it and holding it forever, I've got an option that's got enough time that I can simulate that for the next 3, 6, 8 months, or a year, whatever I'm looking for. Why not buy a longer option, a leap? There's really no time decay because you're buying in the money. The time decay only affects the amount of difference between the intrinsic value and your option cost, which was that break even. So that break even is maximum of $1.50, and it's not going to decay $1.50 in time value in a month or two. Again, you're looking at 6 months. So the time value component is very, 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 very small. So there's no need to go out to that much time. Sometimes I do, and sometimes I get a lot of grief, because I'm buying too much time. And and I don't think people get that time is your greatest ally. So let's talk about trading high volatility. And there are individual stocks that have movement. Now, volatility is simply another word for opportunity. We want the markets to move. If the markets move, it's our job to pick a high probability piece out of the market. So I'm going to talk very quickly about the option wheel. An option wheel is a strategy to buy stocks that you want at a discount or to get paid not to. Now, if I want to buy Apple right now, okay, and I had actually someone come to me with Tesla. They said, listen, I want to buy Tesla, but I'm waiting for it to go back down to $200. This one is trading at $250 or whatever. I said, okay, well, you have the money in your account. He goes, yeah, I got the $20,000. I want to buy X amount of shares of Tesla. He goes, and I'm just waiting for it. So he could put in a limit order, buy it when it comes back down to 200, or what you could do is you could sell the 205 puts for $5 and in the front month for May, and then if it's above 205 at expiration, you get to keep that money, and if it's not, you get assigned Tesla from $200. So you can do that every month. It's a portfolio strategy that hedge funds use as a way to get into a stock at a lower price. Instead of putting a limit order and waiting and waiting and waiting and waiting, if they have the money and they want to get in, they're selling cash secured puts as a way to get into the market. So they want to buy the stock at a discount or they want to get paid not to. Once you get into it, then you can sell covered calls against it to take you out. But we'll get into that here in a second. Let's just talk about the option wheel. The option wheel is selling cash secured puts, and I can't stress cash secured enough. You have the money in your account, you're not using leverage, you have the money in your account, and you want to buy X amount of shares, and you're prepared to buy those shares in those individual stocks that you want to hold for the long term. The idea here is to get high probability profits, 3, 4, 5, 6, 7, 8% in a couple of weeks, 3 weeks, typically less than a month, and do that on a consistent basis in addition to your regular trading. These are high probability trades. The small monthly returns add up. This is in addition to your other trades. And people say, okay, well, a 4% return on risk, that's not a whole lot of money, 5% return on risk. But if you look at it in the context of 25 days, that's a month. So you're looking at 4% a month, multiplied by the 12 months, look at that annualized, and it's very simple. You want to use the rule of 72. Take your annual percentage return, and that determines how long it's going to take you to double your account. So if you get a 10%, let's get 8% annualized return, 8%, that's not asking a whole lot, 8%, but that's a lot better than the bank rates. 8%, you take 72 divided by 8, 9 years. It takes you 9 years to double your money. Do the math on what you're getting, and in that you'll understand the small returns really add up. The idea here is to use this strategy just like investment managers use. Instead of putting in a limit order to buy a stock at a lower price when it dips, you're selling cash secured puts as a way to get into the stock. A cash secured put has the same risk profile as a covered call. You don't do a covered call unless you're prepared to own the stock for the long term. You don't do a covered call on a stock and take in $1 for selling the covered call. If the stock's going to go down $15, that $1 is not going to help you. So you have to be able to hold the stock for the long term. Only stocks that you can hold for months, maybe even years, something that you're committed to. And for me, I'm going to do this on low dollar stocks, so I have limited downside. So I'm going to do it on stocks typically that are $15 or below, so I know, where the bottom is. So don't do it on a $75 stock because there's a lot of downside. The idea is to pick relative high volatility stocks that have volatility of 50% or more, because that's where the volatility works in our favor. And I'm going to choose lower price stocks. Now let me use Sprint. This was an example. The volatility was 49%, if you see that implied volatility. And I'll come back to the rule of 72 in just a second, John. Sprint had some volatility. People were concerned, what's going to happen, what's going to happen, and what's going to happen. Had that support point down around $5. I could put in a price and say, listen, I want to buy Sprint when it gets to $5, all right? Or I could sell a cash secured put, all right? Sell the cash secured put, the 5.5 put, taken in 20 cents. Now 20 cents on your risk, if 550 is where you would be assigned long the stock if the market was below 550 at expiration. minus the 20 cents you took in. So $5.30 is your break even. All right, $5.30 is your break even. Now that's 30 cents below where the market was trading. So that was 6% below. So you're buying it at a discount, or you get to keep that 20 cents against your risk of 530 is a 4% return on risk in 3 weeks. So that's good math. Nice high probability. You can see the year lows were at 536. I would be long from below the year lows if worst case scenario I get put to me. So it's a win-win situation. If I get it put to me, then I own the stock. If I don't, I get paid. So there's no loss if you're prepared to own the stock. That's the idea here. So now what happens with Sprint? This was selling the out of the money put using time decay in our favor, short period of time, 3 weeks. The stock went from 560, 672. So guess what? The stock went up. It would have been better probably to buy the stock, but it was a probability trade. The worst thing happened is the stock went straight up. So we only made our 4%. Okay, that's the worst thing that could happen, is we only made our 4% there. So, you know, that's the downside of doing the cash secured put, is you could have made more if you would have went long the stock. But you know what? Now I cash that money out when the expiration comes 25 days later, and I look for a new opportunity. It's about these high probability trades over and over and over again. To get back to that rule of 72, the rule of 72 is you take your annualized return and divide 72 by that number, and that'll tell you how long it takes for your account size to double. So if you have 8%, then it'd take 9 years for your account to double in value. So if you have a $100,000 account and it makes 8% every year, 8%, 8% a year, 8% a year, it takes 9 years. So the idea that I'm trying to communicate is that small gains can get really big over time, really big, using that rule. All right, selling puts or calls alone are naked trades. Cash secured puts, okay? So to go back to the option wheel, here you go with here. My maximum risk on 100 shares selling a 550 put is 530 because I took in 20 cents. $530. That's the worst that could happen, is that goes to zero. The maximum risk is the stock going from 560 to zero. What was the probability of that happening? Relatively small. And relatively small, but happening in 25 days. I'm not doing it on expensive stocks. I'm only doing it on stocks that are low dollar stocks. How low can a $5 stock go? Zero. How low can a $150 stock go? Zero. There's a lot more downside on the expensive stocks. But the idea here is, it's just like buying the stock, putting in a limit price at 530, but you're getting paid not to. So understand that it's no more risky than doing a covered call. It has the same risk profile as a covered call. You know what your exposure is and so forth. So someone asked if I give this strategy a lot of time. I'm not sure exactly what that means, but let me finish up with a strategy, and then we'll get back into the review again. So that was Sprint. So there's an example of Sprint. The idea here is the stock moved 20% to the upside. We only made 4%. I've got to live with the fact that we only made 4%. That's the worst case scenario. It happened in 3 weeks. The idea is to do these on a consistent monthly basis. And now is the time to be doing them for the May expiration, because we've got about 20 days, 21 days left till expiration in the May contract. So you want to sell the cash secured puts now and use that time decay, that ice cube melting, in our favor. And I've got a tool to do that we'll talk about here at the end. So the idea here is to build a portfolio at a discount or get paid not to generate consistent monthly revenue. Now, when is this the best? Typically when volatility is high. And if you remember last October, when things were coming unglued, that's when we put on a bunch of these positions. Selling the JCPenney $7 put, okay, for November. Sold that option on the 28th. It expired on the 2nd. Took in whatever here, 30 cents. So that was a 4.5% return on risk. ANR, 12% return on risk. RSH, 6% return on risk. Plug, 4%. So it's small, consistent profits. And what you're doing is you're taking advantage of when the market gets inflated. You're selling cash secured puts on stocks you want to own at a sharp discount, taking advantage of that increased volatility. And you're prepared to own the stocks at a lower level. If you look at the last one, let's look at Cleveland Cliffs, for example. Someone asked about a list, and I'll talk about the list of cash secured puts. So you were selling the $7 puts in Cleveland Cliffs. Cleveland Cliffs at the time was trading, if I can remember, like $8.50. So the break even was 15% below. So either I was buying the stock 15% below, or I was going to get paid 7% return on risk. So it's all about the math. We have a tool that I give away as part of our package, as part of our BarChart Bullseye service, the Advanced Option Screener that helps you evaluate and find these cash secured puts. This is just something that I do and I've been doing for a long time on individual stocks that have high volatility, that are small dollar, as a way to get into them lower or get paid not to. And it's just strictly probability trades. So that's what I've been looking for. So this example, these are some of the trades we did for October, and then I'll get moving here. You can see where JCPenney was trading at 767, selling the $7 put. It was 9% lower, 4.5% return on risk. And you can see JCPenney finishes, at 750. So that's out of the money. We get to keep the premium. A&R, selling $2 put, 15% lower, 11% return on risk. Radio Shack, 22% lower, 28% return on risk. Plug Power, okay, look, there's a very, very important support line at $4. Selling the $4 put for a quarter, so I'm able to buy the stock at $375, which was 15% lower, or get paid 7%. Here's Cleveland Cliffs, 27% lower. The stock was trading at $10.90, but the volatility was nearly 100%. Okay, so there you go. I want to take advantage of that. I want to be an option seller in a cash secured put manner. Sell a $7 put, 27% lower if I get it put to me, or a 7% return on risk. That's the strategy. In addition to your regular trades, those were to take advantage of that inflated volatility that we saw in October when the market got real skittish. That's when you look at stocks that, hey, I would be prepared to own those, but I would like to own them lower when everybody starts getting really crazy and excited. That's a strategy you use. So again, let's review that, and then we'll come back and review the other strategy. Only stocks you want to own, only stocks you want to own, only stocks you want to own that you're prepared to own for months, maybe years. Now, if you get the stock put to you, let's say you get assigned that stock at a lower price, if that volatility has increased, then what you can do is you can sell covered calls against it to lower your basis. So you sell a front month covered call that lowers your basis another 25 cents, and if you get called out, you come out profitable. If you don't, the next month you sell another covered call against it. Keep selling it and continually lower your basis until you get it taken away. So therefore, it's called an option wheel. That's where it comes in. If you're using high volatility stocks, probability, the idea here is to sell the puts, and if you get the stock, then sell covered calls, and then repeat. Repeat. That is the key. That is the key. It's called an option wheel. We're going to do that and repeat it, get these high probability small monthly revenue streams in addition. So someone asked a question here. How do you set stops? I don't put any stops on these. I don't put any stops on these because I have the money in the account, cash secured puts, to buy the shares if I get them put to me. So I just let them do what they do, and I wait till expiration, and I either get the stock or I get paid not to. It's that simple. The volatility knocks on the price of the option. You just leave it open and let it go. Exactly. Exactly. That's how we handle it. I want to own the stock. These are stocks that I could put in a price down below, or I could get paid. That's the idea. So let's talk about some of the ideas that I use here at BarChart Bullseye Options, my option service. Some of the published performers here, and if I've got a second, I could show you one that was in Solar City that just took profits on this week. So let's do that. Solar City made 50% in 21 days. That I want to show just because of the textbook factor here of, right, it's going to be right here. Solar City took profits this week. Solar City, if we look at solar is up a huge amount this year. Now, this is actually the specific trade recommendation that got published at my service. So this came out, let's look here. I want to find out the date when this came out. This came out to buy the 42 call for July in Solar City. I can't find the date on it. Oh, entry date on the 1st of April. April 1st, all right? So this is the at-length trade recommendation, the specifics of why and how and what I'm looking at. Okay, so if you look at Solar City, compare it to TAN, which is the ETF that tracks the solar sector. The solar sector was up 30%, but this individual stock was down on the year, down 5%. So looking for that to play catch up. And if you looked at First Solar, if you looked at Sun Edison, all of those solar stocks had gone straight up. But for whatever reason, Solar City hadn't. But it had an amazingly attractive chart pattern. And if you look at this chart pattern, it traded between 50 and 60, 50 and 60, 50 and 60 for 1, 2, 3, 4, 5, 6 months, okay? So leaning on that $50 level was a good level of support. that favored the bulls as far as risk reward goes. So this was the trade setup, looking to buy near that 50 level. So we bought an in-the-money call, the 42 call, which is deep in the money, and that had that high delta and had July. So it had, you know, however many months from April, it had April, May, June, July. So it had about 4 months of time for some good things to happen, 3.5 months of time, I guess. And what I was looking for here, I wasn't looking for the upside target is really $70, because you take the distance of the trading channel on top of the breakout and on top of 60, you're looking for 70. But this worked out to be textbook because Solar City shot up in 3 weeks, went absolutely straight up from $50 to $60. Now that's a great move. That's 20% in the stock, right? That's a great move. But the option that we used ended up making 63%. 63%. Solar City went absolutely positively straight up. And again, we weren't trying to hit the home run. All we were looking for is if the market was going to get back above 55, it was probably going to go to the top of the channel. So Solar City was a textbook example this week, absolutely textbook example this week of using that stock substitution strategy and putting that in action. And again, I'm not trying to be the smart guy. All I'm saying was this was a stock that hadn't participated. It was a bad house on the best street. And guess what? A little fixer-upper, and boom, it's worth a lot of money because it's on a great street. And a lot of stocks on this street have done very, 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 very well. So the concept of this individual stock going against the trend of the sector, unless they were completely a bad apple, you know, at some point, the high tide idea was going to float all boats. So that was the logic behind that. That's what I was looking for with Solar City. So I wanted to bring that out as a stock substitution strategy. So let's get into, there we go. So if you look at some of the performance, some of them happen in very short term, some of them take weeks and even months. I showed you that Apple example, which took a couple months. That's what my option service is using the appropriate option strategy for the market conditions. I'm using my 25 years of experience to identify the right stocks that I think are going to move. You know, I'm not being a genius by using you know, some sort of complex option strategy. I'm making it very simple. I'm using options for the benefits that they have. So that's the Bullseye option service, a subscription service that I offer through BarChart. The idea, and I want to stress how options limit your risk and allow you to choose your probability to get greater returns. They can be very, very simple, and some people criticize me for being overly simple. So what? Simple works. I don't need to be the smart guy. I'm just here to make high probability trades. And what I think is most important is that the options don't require constant attention. I look at things on a weekly basis. That's really it. Nothing is going to change my opinion on a daily basis that is going to make me say that I've got a January 2016 option in Groupon. Do I need to get out of it today? I'm going to look and see how things act over on a weekly basis, and that's really what it comes down to, because I'm looking longer term. So what you get with my Bullseye service, you're going to get you get a couple trades a week, 2 trade recommendations a week. So for the 14-day trial, you're going to get four of the trade recommendations. You're going to get these through text alerts and emails, and that they'll give you very specifically, I showed you Solar City, what it's all about as far as all the reasonings, where to get in, how much to risk, what we're looking for, where our profits are, what the logic is, what the strategy is. I don't want you to use the emails or text alerts to close out, because you get very specifics, you get the specifics on how to manage the trade before you get in. So you're never going to get an email saying, hey, listen, you've got to get out of something right now. You've got your trading plan in place. You use your text updates to tell you, like, if we took profits on something or if we got stopped out of something, just to check your account, just to double check and make sure. You're also going to get access to the advanced option screener that I mentioned to you. BarChart used to sell that for 25 bucks. I give it away for free to my subscribers to help them learn more about options, but that will help you find covered calls, cash secured puts, and spreads, and do all the math and probability. It's a very, very nice tool that helps you pick based on price of the stock. Is it a small cap, large cap, medium cap? You know, it helps you pick a lot of variables so you can do that search for you. It's a very, very nice tool. So you're also going to get a 1-hour weekly webinar with me and a weekly recap that gets sent out to you. And as I showed you, you can see what the online portfolio is. So the 14-day trial, there you go. realtraderswebinar.com. realtraderswebinar.com/BarChart. So if you're going to get 2 weeks, you're going to get 2 trades each week, minimum. You sometimes get more. It's not an active service from the standpoint that you have to wait by your email or worry about that. When I put in a price, you know, I'll say, listen, I want to buy an option for, I don't know, $450 or better. And it might be trading at $400. So you've got 50 cents of wiggle room. So if you don't see the alert or you can't get to your computer, you know, you've usually got a day or two that you could still get into it at a very good value. I'm looking big picture. I'm not looking to be precise. Some of these trades make money in a short period of time. That's great. But I'm really looking to make money over the long haul. That's what this service is looking to provide, and using options as simply the vehicle. So you get the webinars and also daily videos. I've got a daily video, 3 to 5 minutes. I call it "Where's My Head At?" Just evaluating what attracted my attention that day, where I see opportunity, what I'm looking for, and kind of, you know, what's going on with me. The weekly updates, and you're going to get the all the other tools as well and get all this information. So BarChart Bullseye Options. Take your 14-day trial. On Thursdays, every Thursday, I have my 1-hour weekly webinar where you get a chance to ask questions, need to know about strategies, so forth and so forth. There's the price. Sorry about that. $69 a month. If you want to sign up for 12 months, you're going to get a discount. You're going to get it for 10 months price. You'll get 12 months of value. So that's where it is. Someone asked some questions here. What is the minimum account size? I'm sorry if I'm going fast. I just want to make sure that I catch up and don't run out of time. Minimum account size. That's determined by you. You know, you have some limitations with a smaller account, but again, go back to the theory that you want to divide your account into 20 slices of pie. The idea is to make sure that each and every trade has equal weighting. Someone's asked me, okay, well, which one are the best trades? I do put I put a little risk quantifier on each one of these, but if I knew which ones are the best trades were, I would just do the best trades. You know, I think all the trades that I recommend are all good trades. So the idea here is to divide your account into 20 slices. If you've got a $10,000 account, that simply means that each trade is going to be $500. So average, how many alerts per month? So 2 trades a week, 2 alerts a week, times 4 weeks. So you're looking at about 8 a month. About 8 a month. And then there'll be some that you're getting out of as well. Just got out of Valet today. Made, I think, 60% profit, or was in Valet. That was a nice trade if you want to look at that chart. Like I said, got out of Solar City. Moved our stop loss up in the Qs this week. So I don't have a whole lot of positions in the portfolio right now because I've been using the last couple of weeks as we've been drifting higher as an opportunity to take profits. I come from the school of demise, I guess, is that stocks that are distressed, the school of distress. There you go. Stocks that are distressed, that's when I look at them as opportunities because the risk is lower if you're looking to be long on those. So let me answer some more questions here. And divide your account, like I said, into 20 slices of pie, but the idea is to make sure that all of the, that all of the trades have equal weight. Okay, so now I lost my questions. On doc. There we go. So it's on your site. Do you track record of trades, a spreadsheet? Yes, there's a track record each and every trade that's ever done on there. Like I said, for this year, I think we're 22 out of 30 of trades that we close out. Well, we got to add today, so that makes 23 out of 31 for 2015. So that have been closed out. Now we still have positions in our portfolio. Some are winners, some are losers, but they have plenty of time, you know. And so you can look at it right now and see a snapshot in time. The Coke is break even. The Coke had gone up, the Coke had gone down, but it's a January of 2016 option. So, you know, of the closed out trades, what do we say? 23 out of 31. 23 divided by 31 equals 74%. 74% probability on the closed out trades so far this year. All right, let me open this up and answer some more questions. Please sign up for your 14-day trial. Costs you nothing. Your risk is everything if you don't sign up. I don't know where I came up with that, but someone had said that in the past. What trading platform is best? People often ask me that because these are options. I recommend that you go with a firm that specializes in options. And sometimes people have problems with the firms they're with. Not that their trading platform, there's anything wrong with it, but as far as using option strategy, that you get qualified, level 1, 2, or 3, and that limits the strategies you can do. Options firms, Trade Monster, which is now Option House, or Thinkorswim, they don't categorize you. Whatever you have money in your account, you can trade whatever strategy that you have the risk to control. So that's what I think is most important. That's what I think is most important. And one thing that I think is funny, people focus on getting the cheapest commission. Make sure you get good tools and good assistance, because the commissions actually perform a function. If the commissions were free, you would trade too much. You overtrade and you would get away from your discipline. So the commissions force you to think things through. Nobody likes to pay commission, but $5, $10, that's not going to make you or break you. But you need to think through your trade and make sure you have got a good solid plan so you're not reacting emotionally. If we go with annual, it isn't working for us. What refund policy? You'd have to contact customer service. There's a name right there, and they'll give you the exact specifics on that. Having subscription, do we get a regular BarChart subscription? My subscription is a pay service for BarChart Bullseye options. Most of BarChart is free. The only other pay service that I'm aware of is Trends and Futures. So that's a separate pay service. What level do you need for a cash secured strategy? There's the issue. That mathematically, if you're selling a $5 put, okay, you're selling a $5 put and it controls 100 shares of stock, your maximum risk is $500. If you have $500 in your account, then you should be able to do the trade. And that's where you want to make sure you're with some sort of options brokerage that understands that, so you don't have to, and understand and point out to them that the risk profile on a cash secured put is the same as a covered call. So if they let you do covered calls, they got to let you do cash secured puts. So that's the dealio there. There were a couple other questions that I kind of glossed through, and then I only got 2 minutes left here. Someone's asking about the strangle value, long short stock substitution. Yeah, you could use a stock substitution on the short side. Now, being short the market is profitable if you've taken your profits immediately over the last 5 years. For those people that have been trying to pick this top, they might get these short-term downward movements, but if they don't take the profits, guess what? They're out and they lose money every single time. Index on the solar stocks, TAN, yes, that keeps track of all the solar stocks as a basket. I love ETFs in the fact that's one of the divisions in my portfolio. I trade individual stock equity options. I have a section for cash secured puts, and then I have a section for ETFs. ETFs are the greatest vehicle ever in the options on the ETFs, because you can get really sector focused, or really focused like gold or TAN, like we just talked about, or you can look kind of broad and look at the Qs. So I love ETFs and options on ETFs. A lot of liquidity. What other questions are there? Option spread trading. Bear puts, bear calls. Yeah, you can do spreads, but with volatility very low, you have much greater flexibility just buying a put or a call. If you're directional, not to say that I won't do call spreads, because some heavy big dollar stocks, you have to, because if you're looking at Amazon or a Tesla or something like that, you got to do some sort of call spread. But the downside of doing a call spread, if you're buying a call spread, is your maximum profit is only made at expiration. And if the market moves your way, you really just can't cash out that quickly, because that spread doesn't really appreciate completely till the end. But I'll trade whatever strategies are appropriate for the market. I'm just showing you right now what's been working in the marketplace and what's been successful. And it's going to be successful until proven otherwise. And when it changes, I'll just pick another tool out of the toolbox. And that's what the service does. I'm going to take the right option strategy for the right market conditions. So again, I think it's a no-lose situation here. For you. You get 14 days for free. Contact Jay Brown if you had other questions. There you go. Call him on that phone number or that email. And I think I'm finished here. Let me see if there's any last question. My time is up. I want to thank everybody for their time and paying attention, asking questions, participating. Someone shows here your Facebook trade shows $3.70 profit. $3.70 profit on the option. So you take whatever you paid for the option, and if you made $3.70, you divide what you paid, and then that'll figure out your return on risk. So your risk is whatever you paid in premium for that option. So that's what your maximum risk is. And I don't remember what we paid in premium for that option. I think it might have been $10 or something, something of that. No, I think we ended up making more than we ended up making 50% on Facebook. Facebook, I still think has a lot more upside. Just give me my opinion. And somebody else that I think has some real good solid potential over the long term, I think, is BABA. BABA has come back down. It's trading between 80 and 90, 80 and 90, 80 and 90. If you get back above 85, then and hit 90, then 100 in the near term. That stock has not participated with the market and really kind of took all the oxygen out of the air last October, if you remember correctly, when it came out with its IPO. So very similar to what happened in Facebook. After its IPO, it had this long downslide, and everybody was just negative and forgot about it. And then what happened? Facebook came back to life as if people realize how much money they generate, and that's what it comes down to. Can you recommend a stock good for one of the strategies today? As far as new positions that I'm looking to get into, you have to be much more selective now that the market's up at its highs. If I'm looking for calls, I like BABA. BABA, I looked at some longer-term positions in BABA, so that's something I'm very bullish on. I'm looking to get in Microsoft as well, because I think we've got a double bottom. Microsoft went down below 40, actually had some bullish divergence in the fact that it made new lows but not new highs in volatility, so that's a positive sign, and can go, if it gets closer to 42, I'm using that as an area to get long with some longer term calls. Microsoft has gotten beat up, but I think, you know, that it's not going to get left behind in the Nasdaq right now. So Apple, but I don't want to do anything ahead of Apple's earnings. Let's see what happens, because Apple's been trading sideways. So I think there are a number of opportunities. There's always, but oh, BABA popped some today. Well, it's got to get, if it gets back above 85.50, then it's going to make another swing on that 90. So